Hello, and welcome to the First Brick Property Podcast, episode 19. My name is Henny, and I'm here joined by my co-host. Now, I've heard it takes him 6 days to make a property instructional video. You all know him as KM. Hello, KM.
Hey Henny, how are you?
Good. How are you?
Good. It did take 6 days to make a property instructional video. Why to use a buyer's agent? I'm not a very marketing person.
That's passion, I have to say.
It took a long time to make, but it turned out really good. We got some really good feedback on it.
Yeah.
If anyone hasn't seen it, jump on our Facebook, YouTube, Instagram, whatever.
Yeah.
And you'll find part of the whiteboard tutorial series, and it's called 8 Reasons Why You Should Use a Buyer's Agent. It's a very good video, and it took 6 days to make. So when you're watching it, enjoy.
Make a few more and bring that time down.
Well, we will. We've got some in the working, but unfortunately, it's been like 5 days already. So I think we're getting slower.
The next one.
So I'm the director of First Brick Property Buyers Agency, and the purpose of the podcast is to bring a casual show to discuss all things property, with education being the key. Whether you're a beginner or a seasoned investor, this show will be able to further your knowledge and really remove any barriers to getting involved in the exciting and fun world of property. Now, Henny has introduced me, but this is the first time you guys have seen Henny on screen.
Yep.
Now you can really see his nice beard, the better bearded looking man, as we call him.
Now they can all see that we've been lying to them over the podcast.
That's it. So today's episode is a pretty heavy one, big one.
Is, yeah.
So we'll get stuck right into it, and it is property and recession, the big R word.
Yeah.
We should probably start by defining what a recession is and talking about what happens during a recession.
Yeah.
Because as we'll find out, most of our listeners, probably maybe all of our listeners, have never been through a recession.
Yeah, I haven't.
You haven't. I haven't. We haven't been through a recession in our life. So a recession essentially is a period of temporary economic decline during which trade and industrial activity are reduced, identified by a fall in GDP in 2 successive quarters. So GDP is gross domestic product, which is essentially a scorecard of a country's economic health. It measures the value of all goods and services produced in the country, in Australia.
Yeah. So what happens during a recession? So there is a bit of a domino effect here. First, and probably the most obvious one, is that there's fewer jobs. The unemployment rate in April in Australia is between 5 and 6.2% right now. But we've still got a long way to go before we hit the numbers of 1992. And of course, 1992 was the last time Australia had a recession. And at the low point in 92, unemployment was at 11.2%. So we're about halfway of the figures that we had back in 92. And if we compare that to the Great Depression of the 1930s, they had an unemployment rate of 32%. So that's huge.
That
huge
is
numbers
massive.
compared to what we have now.
Yeah, massive numbers.
The next thing that happens is there's less non-essential spending, and in general, spending altogether. So when there's less jobs, there's less spending, and what we'll find, which is what we've already seen, is places like cafes, restaurants, pubs, clothing stores, they take the initial hit, and it's the biggest hit that we see. The other thing that we see is wages drop. So there's fewer jobs, there's a stagnated or decline in wages, and there's more people looking for work, and there's less jobs available. So we have a bit of a supply and demand issue here in the workforce. And when that happens, there's no need for competitive wages because employers have pretty much anyone to pick from when they're looking to hire people.
Yeah.
Because everyone's available.
Supply and demand.
Yeah. And the last thing is that second last thing is that debt increases. So when people are out of work, they've got less wages coming in or no wages coming in, and they'll borrow against their house, or they'll find other means of loans. They start using credit cards, so debt increases. And the final thing is there's a drop in travel. So less jobs, less wages, more debt, less travel. And in this particular situation, because of COVID, travel has just been wiped out
Yeah.
completely.
Down to zero, essentially.
Yeah.
So I guess the next big question is, are we in a recession? So the GDP figures from the Bureau of Statistics show Australia's economy shrank 0.3% in the March quarter. And that was due to bushfires in the early stages of the year, and then the coronavirus pandemic, the start of that as well. With a big fall in GDP certain in the current June quarter, as you know, coronavirus continued to sweep the country and the world, and economic activity was almost halted. That this is going to mark Australia's first technical recession in 29 years.
Yeah.
So, yes, we are in a recession right now, and that is the first time since 1991, dubbed by then Treasurer Paul Keating as the recession we had to have, the very famous recession, and our last recession. So it's been 30 years. And what happened and what's happening and why we're in a recession now, we've seen a sharp fall in consumer spending. It's gone down about 1.1% over the last quarter. And that was a key contributor to the weakness, while housing construction has been down 1.7% and business investment 0.8% down as well. By industry, if we look at it by industry sector, the weakest sectors were, and again, this isn't surprising, hospitality down 7.6%, which is huge, and transport services down just under 5%. These falls, they likely represent not just the initial impact of the COVID-19 shutdowns, but also the effect of the summer bushfires as well that we saw at the start of the year.
Yeah.
Manufacturing was the strongest industry, with output rising a solid 2.1% in the quarter. So that was a good news story there. But the recovery is unlikely to be a V-shaped recovery that people are looking for and people are hoping for. But further stimulus will likely be required to support growth over the next year or so. As we go through the show, we'll see that further stimulus will be a key player in the future direction of our markets and what's happening in the future.
Yeah. So if you're under 30 and really under 40, like we said earlier in the show, this will be the first time you go through a recession. We've had 30 years of economic prosperity and growth, and a large portion of our nation will have never experienced a recession. Even if we go back to the 2008 GFC, Australia came out of the GFC virtually unscathed relative to other countries in the world. And it's one of the reasons why the G20 summit, which happened just after the GFC, was held in Australia. The reason for that was because we weathered the GFC pretty well compared to other countries out there. So we've got an extract here from Treasurer Josh Frydenberg, and he said, Treasury were contemplating a fall in GDP of more than 20% in the June quarter. This was the Economist's version of Armageddon. This is what he told reporters at Parliament House. So it was in this quarter, the March quarter, that consumer and business confidence fell to its lowest record, that the ASX 200 lost a third of its value, and on the 16th of March saw its biggest daily fall of 9.7% on record. When you combine that with the ongoing drought, which saw the GDP fall by 2.4% in the quarter, and the devastating impact of fires that were raging across the states, one looks back at the March quarter and there wasn't much good news.
So yeah, it's good.
Yeah, so if there was if we were ever going to have a recession,
it's going to happen now.
This is it.
Yeah.
So in this context, the fact that the Australian economy only contracted by 0.3% shows the Australian economy's remarkable resilience. That's pretty huge.
Yeah, I mean, for a country, I mean, we've seen, and we'll go through some numbers across some of the other massive economic countries of the world, and they've been hit by this global pandemic as well.
Yep.
But we also had January and February pretty much massive fires across the entire east coast of Australia, wiping up a lot of homes, a lot of families, a lot of jobs. So there was a lot going on, and we've only dropped 0.3% for the first quarter of the year. That's a pretty fantastic result.
Yeah.
And we'll go through what other countries are looking like now, and they've only had that global pandemic side. They didn't have the added fires to it.
Or the droughts.
So we'll see how we've compared to some countries.
Yeah. So if we look at China, for example, they fell by 9.8%.
That's huge.
France fell by 5.3%. Germany 2.2%, and the UK similarly 2%, and the USA fell by 1.3%. So again, we dropped by 0.3% compared to all of these countries.
Yeah.
And we had, our economy was already hit before the pandemic because of the droughts and the bushfires.
Yeah. So that's quite impressive from the people, from the Australian people.
Yeah, 100%.
The people that live here, making sure that we don't let these disasters get the better of us and our way of life, and making sure that life continues.
Yeah.
Obviously, the pandemic put a hold on a lot of things, but to come out on a 0.3% down for the quarter only is quite impressive.
Yeah.
We'll probably see a bit of a deeper drop in the next quarter, the June quarter.
Yeah.
But 0.3%, very, very impressive.
Yeah.
Let's compare this to the last recession we had. So we're talking 30 years ago. We'll set the scene. 30 years ago, we had a recession in Australia. And most people in the workforce today were too young, as we mentioned, to have a job back then or even be alive. And anyone under 35 is probably too young to remember it. So you had to be 40 years old or older at the moment to really remember what happened back then. And the recession was severe. It was the worst since the Great Depression of the 1930s, and vast number of people lost their jobs or couldn't even break into the workforce. The unemployment rate continued to rise even after a slow and tentative recovery began, peaking shy of 11% in 92. 11% of the population was unemployed.
Yeah.
Massive numbers. So
which is double what we have now.
Correct. So we're sitting at 6.2, the latest numbers. It's a crazy amount more people that were unemployed. For people aged 18 to 22, back then, unemployment peaked at 17%. So as school leavers and graduates had their career ambitions and their dreams, they were dashed or delayed by a lack of work. There was really nothing available for them.
Yeah.
In the early 90s, the recession followed the boom period of corporate excess and speculative frenzy, characterized by companies taking big risks and massive amounts of debt.
Yeah. And this would have been exacerbated with the dot-com boom.
Yes.
The introduction of the internet and, that was going wild. So that just exacerbated the whole situation. Yeah,
correct. So as you mentioned, the dot-com boom, there was a lot of bigger risks being taken, a lot of debt being taken as well. And then obviously once this recession hit, it didn't help at all.
Yeah.
The situation. It ended in a financial crisis as central banks drove up interest rates to curtail runaway inflation. So it was not fully manufactured, but there was some purpose behind the central banks doing what they did. In the lead up to COVID-19 downturn this year, the Australian economy was far from booming as well.
Yeah.
So we weren't in the greatest spot, as we mentioned, the fires and whatnot. But if we go a little bit before that, the inflation rate was at a historic low. Wages growth had stagnated for 6 years or near record lows. Productivity growth was extremely low, and economic growth was tepid and had been below trend for a long time, for years.
Yeah.
So Paul Keating, who was then the treasurer, dubbed the early 90s the recession we had to have. The economic shock of 2020 is the recession we chose to have. And we say it's the recession we chose to have because of the following part. The downturn induced by the state in order to prevent the spread of a virus with a potential to kill a large number of citizens and overwhelm the healthcare system if not curtailed. So essentially, if we didn't stop and we didn't go into lockdown and isolation and everything, that we run the risk of mass death.
Yeah.
Mass population death. And, we can see things like we see the US do have mass death and other countries, huge numbers.
Yeah.
So I think this is going to be dubbed the recession we chose to have.
Yeah.
KM 2020.
So back at the last recession, property prices had been flat or failing around the country even before the recession hit. However, overall house prices didn't crash during the recession. In fact, some locations, including Brisbane's property market, thrived. The biggest losers were Melbourne and Sydney, with house prices falling 6% and 5% respectively.
Yeah. So we got a little graph here. I'll try and pop it into the the video version of our recording onto YouTube. So if you are watching on YouTube, we'll try and have that graph there for you to see it.
Yeah. So how about during other periods of economic hardship? While overall property values have been resilient to economic shocks, there is no one property market in Australia, and different states have responded differently depending on their own economic circumstances. What does always happen, though, is that the transaction numbers decrease significantly. But economic shocks, world economic downturns, and recessions don't necessarily mean a crash in property values. I guess that's a pretty important note.
Yeah.
Because, we know that we're in a recession. It doesn't mean that house prices are going to crash. They haven't previously.
Yep.
And it doesn't mean that it's going to happen now as well.
Yeah.
So just keep it in the back of your mind.
Yeah. Australian property is a bit different.
Yeah. And on that note, I'll mention that during the GFC, there was a world-renowned economist, and I can't remember his name, but he predicted the GFC. But not only that, he predicted the effects of the GFC in every single country. And he got everything right.
Yeah.
With one exception, the Australian property market. And even after it happened and we didn't crash, he still couldn't understand why. It just didn't make sense that the housing market in Australia didn't crash during the GFC.
Yeah. I think it's hard for overseas because we see a lot of economists from overseas. There was Harry Dent the other day was talking about Australia's property market and has been talking about Australia's property market for a long time. Overseas economists, they don't understand Australian property.
Yeah.
And they don't understand Australians' love affair with property.
Yeah.
And, they don't realize what we will do to hold our properties.
Yeah.
People will get a second job or third job.
Yeah.
They'll cut costs. They'll eat staples for as long as they can. They'll defer holidays and they'll defer loan repayments, whatever they can to hold their properties. Our property market acts very differently to the way the rest of the world's property market works. And just on your story, I'll add a little stat. I mean, these numbers might be a little bit off, but there's a stat going around that says economists have predicted 72 of the last 2 recessions. So think about that one. 72 of the last 2 recessions. So, they're constantly predicting recessions and property crashes and whatnot, and they're still waiting for it to happen. So we'll keep talking about why and what's happened in the past. Speaking of like previous moments in like the GFC and whatnot, let's compare it to, for example, the share market.
Yeah.
If we look at the housing versus the equities or the share market during some significant points in time, what do we see? So 2008, global financial crisis. Share markets take a beating.
Yeah.
In 2008, the Australian share markets, the All Ords, up until the GFC, were on record high numbers, booming.
Yeah.
As the GFC hit, we saw them slump like big time, big crash. And there's also a graph here that I'll try and upload onto the YouTube version, but a huge dip, huge crash in the market. In that same time, the property market did dip, very small dip. Like Henny mentioned, Sydney, Melbourne, we had about 5 and 6% dips. Brisbane increased though. So overall, we still had a dip, but it's nothing. And if we get the chart up, even on our socials, you'll see the difference, huge difference between the share market and the housing market in the GFC. If we look at the transactions, so that was in terms of values. If we look at the transactions and what the activity level was like, we see a very similar pattern between the two, between the housing market and the share market. Both transactions dipped to almost record lows, or they were record lows for both markets, and they almost followed the same exact trajectory. Difference is though, when we have very low transactions in the property market, the market's holding its value.
Yeah.
And I think that's why the property market, one of many reasons why the property market acts differently to the share market and to every other part of the economy, and why it doesn't just crash like the share market does. Because low transactions mean people are holding, and it's a fundamental need and it's a fundamental asset. So people are holding it, and it's not dropping in value. Whereas in the share market, people are holding because there's no transactions, means no one wants to buy. People still trying to sell it off, but no one was willing to buy, so the prices just kept going lower and lower. So we'll put those two graphs side by side so you can see them. We do have some other examples of other times that this occurred. If I can switch my sheet. It was a similar story during the Asian financial crisis and the Great Depression. We saw similar curves and similar lines. So big takeaway there was that housing values have generally held relatively firm during these periods, but showing a strong upward trajectory during stimulus measures I'll start that again. Upward trajectory due to stimulus measures, such as low interest rates, but transactional activity has been more affected. So there are stimulus packages and government intervention that shows us that the housing market kind of comes back and starts to go up in value again. But the transactions are definitely as affected, if not more, than the values. So what's going to happen in the market this time? The recession we chose to have.
So this time around, a drop in consumer sentiment and weaker economic conditions will again impact dwelling values. But how much they will fall remains uncertain and will depend on how long it takes to contain COVID-19, how long the social distancing regulations will be enforced, and what future additional support the government will give to shore up our economy and our businesses. And we've already seen that, our government has already started putting things in place right from the get-go to try and help businesses and to try and help the economy in general. So some positive signs are that Australia is coming out of the lockdown, not just earlier, but better than expected. The restrictions on our property markets are already starting to ease. And after a marked fall in March and April, the number of property transactions occurring started to pick up in May and should continue improving. So that goes to, the transactions that you were talking about a bit earlier.
Yeah, for sure. So I think that's very important. And this is just my own personal view, not the company's, not the show. My own personal view, though, is that we should be quite thankful that the government had some money in its budget to be able to invest in stimulus to keep our economy moving and help us during this health and economic crisis. I mean, we've seen other countries around the world really, really cop it much worse than we did. I think we did a good job. I think the government did well, and they've been putting in stimulus packages. And just today, they're recording, there was a new one, the $25,000 grant for renovations. How far that's going to go and how much of a change and how much of a difference it's going to do, hard to see at the moment. I think they're focusing on some bigger projects at the moment, but one of many, and there's an arts and a few other things coming up. So I think good job to the government for getting us out of this mess, I guess.
So on that note, the 8 major capital cities declined 0.5% in May, the first monthly fall since June last year, as the economic impacts of the coronavirus pandemic took its toll. Considering the weak economic conditions associated with the pandemic, a fall of less than 0.5% in housing values over the month shows the market has remained pretty resilient. This can be attributed to something we spoke about and predicted in Coronacast 1, where we mentioned Australians' love affair with property and that we would do all we could before being forced to sell our houses. And this can be seen through the transaction numbers.
100%. So what stimulus? So we've spoken a lot about stimulus and the government helping with different packages and whatnot, and things that being manufactured to try and get us out of a recession or get us out of this low economic point. What stimulus is there to help us? So the RBA's decision, first thing, so continued low interest rates is a huge factor, helping to support the market. Many homeowners have interest rates lower than 3%, and investors with similar interest rates too. So if you look 10 years ago, 15 years ago, I know my dad, he had interest rates of 9, 10, 11%.
Yeah.
So very different numbers back then to now. So super low interest.
And I
Go ahead.
think I think during the last recession, I think interest rates were at 17% or close to 20%.
Yep.
So we're pretty lucky to have interest rates. Sure. I mean, mortgages are a little bit higher, but having said that,
3%.
Less than 3% interest rates compared to 17 to 20%. It's huge.
And those interest rates are going to stay and remain quite low. I mean, the RBA is going to sit at 0.25 for a while.
Yeah.
They won't go lower. They've said that's the minimum effective one. Yeah. They're not going to go lower, but they're not going to be increasing that for a long time.
Yeah.
0.25%, less than 3% on a home loan. I mean, money is almost for free at the moment. So that's a huge factor. So banks, another thing is banks extending holiday periods and interest only to help customers continue to make their payments.
Yeah.
That is massive. I know of people personally who have been affected, and they've recently purchased property, and other ones that have had their property for a while and been affected, and their tenants are not paying, and they've just put a break on their loan.
Yeah, that's huge.
They're not paying their loan until they can get that money back.
Yeah, and we did speak about this previously in one of the previous podcasts, and banks have really come to the table. And it's helped landlords be a bit more lenient with their tenants as well.
Yeah.
So the country's kind of coming together here.
Trying to help each other out.
Yeah.
The Aussie way.
Yeah.
As expected, like we mentioned, the RBA has held the rates at 0.25 for June.
Yeah.
Governor Philip Lowe said the following. He noted that the declining infection rates in many countries and the easing of the restrictions, if that were to continue, meant a recovery in the global economy, and it could get underway sooner than initially anticipated to recover. In regards to volume, this is very interesting. Housing volume had built up right on. I apologize. So he continued to say this will not increase the cash rate target until progress has been made towards full employment, and is confident that inflation will be substantially within the 2 to 3% target band. So it's likely that the fiscal and monetary support will be required for some time. So him saying this is saying we're not moving.
Yeah.
We're sitting on 0.25% for a while. It's not going anywhere. No stress. Fix everything else first, and then we'll look at the interest rates.
Yeah. So I guess this is the time to take action and be ready for opportunities that will present themselves as the market moves on. So yes, times are tough. Times are really, really tough. And they're tougher for some people more than others. But this will pass.
Yeah.
And this is your time to just focus, think ahead, make a plan for yourself. I mean, if you're able to, this is probably a good time to speak to a financial planner to help you manage not just your finances now, but just to help you get out of this when the time comes and that this recession does pass.
Yeah.
You can't put a price on good financial advice. So if you can get it, it's probably something to do.
Yeah.
Otherwise, we're pretty fortunate to be in a country that seems to be handling this recession better than other countries.
Yep.
And that for, people that are in the property market, that they've invested in an asset that's pretty resilient and that's holding its own in this dreadful time.
Yeah,
I guess.
that's it.
Yeah.
So, like you mentioned a little bit before, we've seen transactions increase week on week for the last few weeks. So that if we continue, that will return to normal, and that will help.
Yeah.
We'll get there pretty quickly, like you said. So, also, like you said, time to take action. If we look at those graphs, the people who invested during economic downturns usually came out with the biggest gains.
Yeah.
In the property market. So, if you have a stable job, if you have stable income, and you've got a lot of buffers in place, 6-month, 12-month buffers, just in case, you lose a tenant or you lose your job, whatever. If you're in a stable and healthy financial position, this is a good time to be in the market.
Yeah.
There's not a lot of competition, and there's some opportunities out there, and we're seeing opportunities every single day. in our work, and we're buying them for clients. So definitely, hit us up if you're interested in that. Otherwise, it's a time to save money. It's a time to make sure your finances are in order, and like you said, speak to a financial planner who can really help you with that. And if you need a financial planner, feel free to reach out, and we can link you up with some good financial planners as well. Cool. Anything else to add to that?
No,
nothing. Beautiful. Well, thanks for listening, everyone, to the recession we chose to have episode. Hopefully this episode has shed some light into what's happened in the past, and what we think is going to happen during this recession as well. One more point, I think the media has a big part to play, and we I'm guessing what the media's part is going to be, and we're going to see headlines flooding. Facebook, Instagram, newspapers, everything. We're going to see a lot of, we're in a recession, crisis, big headlines. Just remember, the media has to sell their agenda, or have to sell newspapers, have to sell their media. So look into everything. Listen to podcasts like ours that have nothing to gain either way, just trying to talk about stuff we like, and really research yourself. So hopefully we save some people from falling into media trap, and maybe make some people some money through good property decisions today. If you're looking for any of our content, any of our other stuff that we do post daily. You can find us on Facebook, Instagram, LinkedIn, YouTube, TikTok. If you want to find that 6-day video, it's on YouTube, Facebook, and Instagram. Find it. It's a great video. And if you have any topics you'd like to discuss, send us a message at hello@firstbrick.com.au, or shoot us a message on our social platforms. If you enjoyed today's episode, we'd love a review. That would help us get up higher in the charts and allow us to find more, and to allow more people to find us, to listen and learn. There is actually a really good review. I'm going to read it out next week. Got a good one. They've mentioned you specifically.
Really?
So we'll mention it next week on our 20th episode. So send us your 5-star reviews. Also, pass the pod. Just let one person know that you think would enjoy this podcast. Just one person. Let them know about it. Let them listen. Pass the pod. Buying property is our passion. Helping you do it is our mission. See ya.
Thank you.